Hello everyone, welcome back to the channel. In today's video, we will discuss two important accounting and financial reporting concepts. The one is value added and another is value added statement. These concepts help us understand how much wealth an organization creates and how that wealth is distributed among different stakeholders. Let's begin with the meaning of value added. Value added refers to the additional value created by a business through its production and operational activities. In simple terms, it is a difference between the value of output produced by a company and the cost of goods and services purchased from outside suppliers. The formula for value added is sales revenue minus cost of bought in materials and service. For example, suppose a company sells its products for rupees 10 lakh and spends rupees 6 lakh on raw materials and other services purchased from outside suppliers. Then value added results rupees 10 lakh minus rupees 6 lakh equals to rupees 4 lakh. This means the company has created an additional value of rupees 4 lakh through its business activities. Now let's understand the meaning of a value added statement. A value added statement is a financial statement that shows how much value or wealth has been created by an organization during a particular period of time and how that value has been distributed among various stakeholders. The major stakeholders inside and outside of the organizations are particularly employees, government, capital provider, and business itself. So the additional value created by the organizations is distributed to them. Value-added analysis. Value-added analysis are methodical approach to sharpening the business efficiency and effectiveness of operational process from the perspective of value addition. It involves breaking down those operational processes into smaller components that can be individually improved or removed and measured to quantify increased value over time. There are lots of importance of value-added analysis in management accounting. Among them, the key importance are as follows. The first, it shows the total wealth created by the organization. It highlights the contribution of employees, management, investors, and government. It promotes transparency in financial reporting. It helps stakeholders understand how the generated wealth is distributed. And it reflects the social economic contribution of a business to society. Further information is that from the analysis of value additions, it can be implied to measure the efficiency and effectiveness of employees inside the organizations and the productivity of capital as well. Before calculating value added, we have to understand at first the value added statement. The value added statement begins from gross sales revenue and we subtract sales revenue, sales return, discount or rebate, goods used for sale consumption. Then we get net sales revenue. And then we add closing stock of finished goods, work in progress and raw material and subtract opening stock of finished goods, work in progress and raw material. Then we get gross value added. Thereafter, we subtract cost of bought in material, which includes raw material purchase, less purchase return, power and fuel, coal and coke, consumable stores and supplies, overhead expenses, carries inward, import duty, excise duty, repair and maintenance of the plant, manufacturing overhead, or that means factory overhead, and also subtract the cost of services including insurance, audit fee, rent and rates, transportation expenses, printing charges, office and admin overhead, carries outward, and selling and distribution overhead. There are at last we add the other source of income such as dividend receipt, interest on investment, rent, royalty, discount, commission receipt, and gain on sale of fixed assets. Their net value added results. And this method is termed as additive method. Then we can also calculate value added by using additive method. This method includes pay employees, to pay government, to pay capital provider, and to provide expansion of assets. At last, we add return profit for the year. Now we are going to prepare value statement by using both subtract method and additive method. From the information given in question number 1, the information are regarding all the income and expenditures over the years 2026, and further information is concerned with number of employees, working days, net fixed assets, and net worth. We start from sales revenue. The sales revenue is 40 lakh, and then we subtract sales return, which is rupees 2 lakh. By subtracting sales return, we get net sales of rupees 38 lakh. Thereafter, we add closing stock and subtract opening stock of finished goods. So, adding closing stock and subtracting opening stock, then we get gross value added, which is rupees 39 lakh. From the gross value added, we subtract cost of bought materials and services, which consists of raw material purchase. That means subtracting purchase return amounting to rupees 14 lakh, and power and fuel 6 lakh, stores 1 lakh, manufacturing overhead rupees 1,50,000, selling and distribution expenses 2 lakh, then administrative overhead rupees 2 lakh. Then we get total cost of both materials and services of rupees 26 lakh 50,000. Then add income from other source, which consists of commission income and other income. That means gain on sale of assets. So totaling rupees 3 lakh 75,000. So we get net value added of rupees 16 lakh 25,000. Under the additive method, we start from to pay employees, which consists of salaries to staff amounting to 7,50,000, foreign fund contribution 75,000, other fringe benefit 1,50,000, totaling amount of rupees 9,75,000. Then after to pay government, which consists of income tax paid and other tax paid of totaling amount of rupees 70,000. So in third stage, to pay the capital provider, which consists of interest on loan and dividend paid to all equity shareholders, 50,000 and rupees 1 lakh, totaling of rupees 1,50,000. And then two assets expansions, which consist of the depreciation amount of rupees 30,000. At last, we add the return profit for the year, which amount of rupees 4 lakh. And total, we get net value added as rupees 16 lakh 25,000. From these value statements, we can also analyze the labor productivity and capital productivity ratio. Under the labor productivity ratio, we calculate 4 5 ratios, which consist of value added per employee, which results rupees 8,125. And this ratio measures the contribution of each employee to add the value in company's product and services. The another second ratio is value added per working days. The formula for value added per working days is net value added divided by total working days, resulting rupees 5,416.66. This ratio measures the contribution of every stakeholders in an organization each day to create the value. And the third ratio is waste distribution ratio, and that results 60%. It means the degree of contribution of investment in employees to create the value. And the fourth ratio under the labor productivity ratio is labor equipment ratio. The formula for this ratio is net fixed assets divided by number of employees. That results to 1,000. And this ratio measures the effectiveness of assets allocation to the employees. It also measures to what extent the fixed assets have been utilized by every employee. And the last one is wage based, amounting to rupees 4,875, and this ratio measures investment to the employees per day and per employee. Under the capital productivity ratio, we calculate value added to net worth and value added to fixed assets, and this ratio measures the value addition of business goods and services by every rupee amount of capital employed and investment in fixed assets. In this way, we can prepare the value added statement under both additive method and subtract method, and also analyze the value added from the perspective of labor productivity and capital productivity. Thank you.